Could inflation be the solution? Welcome to Real Vision Daily Briefing. It's Wednesday, February 8th, 2023. I'm Ash Bennington, and I'm joined today by Vincent Deluard, Director of Global Macro at StoneX. Before jumping in, I want to mention that right after today's show, we will have a live Ask Me Anything with Tony Greer at 5 p.m. Eastern Time. That's right after this show. You can watch both on YouTube and on our website at realvision.com. So stay tuned for that as well. Vincent, it's a pleasure to have you back here and to be with you once again on Real Vision Daily Briefing.
Always a pleasure to be here. Good to catch up.
It's also very timely. Your work today is the basis of a Bloomberg story called Bull Case on Stock Crash Sees End of Fed Gifts to 1%. It's a really thought-provoking story and one that I wanted to give you an opportunity to set up a little bit. It's based on some of your work, a 2023 StoneX Global Macro Report called The Bright Side of the Bear and the Blessing of Pain.
Yes, it's been something that I've been thinking for a long time, and something that should not be controversial, but it's always very controversial whenever I mention it, is that the wealth effect, which has been kind of the religion of the Fed since, I think a speech by Bernanke in 2010, that,
Right.
This is how to stimulate the economy with the wealth effect, benefits the wealthy. I really don't see how that could be seen as controversial, and how engineering a high asset price economy, which seems to have been the goal of monetary policy for at least 20 years, exacerbates inequalities. And I believe once these processes run its course, it becomes detrimental to growth, and it sends the economy in this very low growth, very high asset price equilibrium, which is ultimately unsustainable. And in my view, in my framework, inflation is the genie that will come out of the bottle, the Deus ex machina that will help us go from that paradigm, the paradigm of the new normal, low growth, low productivity, low birth rates, low household formation, high inequality, millennial and Gen Z getting squeezed, to a new, perhaps more sustainable environment, something that would look a lot more like the early 80s. And in order to get from where we are today to where we should be in this kind of happier future, we need a decade of forced deleveraging. And inflation is, in my opinion, if it's moderate inflation, not Argentina-style inflation, but 5-7% inflation, is the least politically painful way to achieve that transition.
Vincent, it's such an engaging idea, and one that we haven't heard here on this program, this notion that this has the positive ability. Many people would cite the same facts that you did and then build a bear case off it. But to hear you building a bullish case for economic growth and for distributional issues, really quite impressive. I wanted to just jump right in here and give folks a flavor of this report, because I think you stated it so well in the report. I'm just going to read from it. This is The Bright Side of the Bear and the Blessings of Pain. This again from January 2023. Quote, "In markets, understanding that losses are natural and fundamentally healthy is a sign of discernment. By clearing out the speculative excess of bubbles, bear markets regenerate the economy, force long postponed changes, and pave the way for more prosperous times." This report will illustrate 5 ways in which the brutal bear market of 2022 is curing the global economy from secular stagnation and the sterile addictions of the 2010s. And I just wanted to make this point here, because this is an important point that you raise in the very next sentence. Quote, "The 2022 bear market and wage growth finally shrank the asset price to labor ratio. The forever bull market enriched the wealthy, the idle, and the old at the expense of the poor, the working, and the young. Lower asset prices will support sustainable growth by allowing the young to buy homes and compound wealth at a higher rate." Boy, it's no surprise that Bloomberg jumped on that story. It really is a compelling point.
Well, thank you. And I don't think it should be that controversial, especially because this is the story. The boomers experienced that and benefited from that themselves. I mean, when the boomers came of age in the 70s, we had very high inflation, something that felt horrible at the time. The great American malaise in the word of Jimmy Carter, blackouts, stagflation, all that, and it felt bad. But if you take kind of a broader perspective on what happened during the 70s, it was actually quite beneficial. It allowed boomers to buy stocks. I mean, at the beginning of the decade, we had the Nifty 50s. These were the FANG stocks of the time.
Right.
They were trading from like 90 times earnings, right? So no one could buy them. By the end of the decade, they were trading at 9-10 times earnings. By the end of the decade, you could buy long-term treasuries at double-digit yield, and you could compound wealth. You could buy a house for a fraction of what they cost today. Now, of course, you paid a bit more in terms of interest rate, quite a bit more, but wages went up very rapidly during this decade. So this was a decade of distribution of wealth that allowed for the next accumulation of wealth in the 80s and 90s, the great bull markets and so forth. And what I'm hoping is happening now is that the same phenomenon is happening for millennial and Gen Zers. We've been really suffering from this kind of, let's call that the boomer glaciation, right? A period of constantly rising asset prices and flat minimum wage. I think it's been, 30 years since we raised the minimum wage. So the one chart that I like to show, I don't know if we'll mention it here, is
in fact, I think we've got it queued up and ready. This is something that really struck me, the price share of the S&P 500 index in work hours. And I just want to read the quote for people to set this up, because really, I thought this was just a striking statistic that you pointed out here. Quote, the chart shows various wealth to income ratios effectively measuring how long workers need to toil to buy one share in the S&P 500 index. For example, in 1980, 1 week at the minimum wage of $3.10 bought a share in the S&P 500 index. At the December 2021 close of 4,766, it took workers 4 months of minimum wages to buy one share in the S&P 500 index. Let's talk about that for a minute, because it really is a quite striking statistic. By the way, I should say the S&P 500 here today closed out the day at 4,117 for those keeping score at home. It's a staggering number. Essentially what you're saying is that, it's 1 week versus, whatever the number is there, the plug number 12. It's a 12x rise in the valuation of the S&P 500 relative to the wage component of the economy. And that's just devastating.
Yeah, and I think what it captures really is the anxiety and the angst of the millennial and Gen Z, the feeling that no matter what I do, the deck is stacked against me, and right, I cannot make it. The opportunities that were offered to my parents are not offered to me. It's not because we eat avocado toast or we spend too much time on TikTok. The reality is that it was a lot easier to acquire wealth and build wealth and compound that wealth at a high real rate of return in the early 80s than it was today. It was easier to buy a house, and somehow, we need to fix that. Again, we need to think of this in terms of a generational trade-off. I mean, you can think of the young generation, with the exception of, the trust fund kids at NYU, as asset poor and labor rich, right? If you are young, all you have is my time and my labor. You're time rich, labor rich, and asset poor. And you're going to go to the marketplace and you're going to trade your time and your labor for people who are running out of both, typically retirees. And with that, you're going to try to acquire assets. Conversely, when you're old, you become time poor. We're all mortal. And labor poor. You may be retired, or you may no longer be able to master the tools to work for. So you were trying to convert your financial asset that you acquired in your life into the labor of others. And that ratio that we measure, the one that has been multiplied by 12 in 40 years, is the term of trade between generations. And what the rise of this ratio tells you is that at some point become unsustainable. And I think this is exactly where we're getting in the late 2010. You get to a point when people stop making babies because they see, well, it's too expensive to send them to school, university, buy houses. Young generation can never get to the point where they can buy a house and start making kids. So you start having this negative impact on growth, which is kind of what we saw for 40 years, where trend growth keeps falling and falling because the young generation is It's stuck in place and it's no longer growing. And in a way, how do you solve that? How do you get a ratio to go down? Well, you reduce the numerator. Numerator is asset price, and you increase the denominator. The denominator is wages. What happened in 2022? Precisely that. Your numerator shrank by 20, 22%, depending on which index we're looking at. And then your denominator, wage growth, increased by 5%. But again, 5% is an average. Look specifically at wages for the young, the uneducated, minorities, paid hourly. That was going much faster, 7 to 8%. So behind the scene, we are seeing this great rebalancing happen. And if I were in charge of public policy, I would not go against it. I mean, I would try to avoid the most destructive effect of inflation. Like, you don't want inflation above 9%, but I think that's something we avoided. You want the bear market to be somewhat orderly. But that process is fundamentally healthy, and it's going to ultimately help to rebuild American growth and the American middle class.
Vincent, I think you've got yourself a best-selling book here if you write this up. You can call it "It's Not the Damned Avocado Toast." There's something about folks of a certain generation who just seem to love to lecture millennial and Gen Z folks about the challenges that they have. But it's not the avocado toast. It's not Tinder culture that's preventing household formation. It's these very real, very material challenges that you document here in this report. It's something that people feel viscerally, emotionally. What I think makes this report so great is that you give the statistics, the data points around it. I'm just going to read one more quote here. This again, if we could put that chart back up, Gabrielle, I don't know if we can bring that back up on the screen. But the 2022 everything bear market caused a rare decrease in the cost of assets in terms of labor. Stocks dropped by 20%, while average hourly earnings grew by 5%. So workers' stock purchasing power increased by about 25%. Furthermore, these gains were strongest for the workers who suffered the most under the old regime: the young, the least educated, the poor, and minorities. As shown in the chart below, young, non-white, and hourly paid workers enjoyed record wage growth last year. Gains have moderated a bit in recent months, but job switchers still enjoy pay raises of 7.7% versus 5.5% for job stayers. As long as this kind of arbitrage persists, the great resignation/renegotiation will probably continue, and labor market should remain tight, which is a great thing, particularly for those workers, Vincent.
Yes, and fortunately, this is something where we continue to see strength that surprises investors. Like the latest job number was really a blowout, right? I mean, we had 500,000 plus job creation, consensus for 150. We have jobless claims falling when people expected them to rise. So we are seeing this process, and I think that is kind of if you listen to the Fed, the message is very confused. It's very blurry now. I mean, on 1 week they're like, "Oh, we're gonna, we're gonna raise and keep them there," and then suddenly last week, "Oh no, I'm cool with the rally. Just do whatever you want." And I think that speaks to the Fed confusion, because on the one hand, they they are worried about their past mistake. They're worried about the inflation, but they see it fall down. And they also see that what's fundamentally going on in the labor market is a good thing. It's a good thing. I mean, you want to have a tight labor market. For 40 years, and the US was not so bad. I mean, as you probably heard, I'm from France. I mean, growing up in Europe, unemployment, especially youth unemployment, was like a Damocles sword on top of everybody's head. Like in Italy or Spain, you'd have 50% youth unemployment rate, people staying at their parents until age 45.
Right.
Right. Having a hot labor market is fundamentally a good thing. And I think part of the internal debate at the Fed is, do we really want to kill the labor market? And how much pain will we have to inflict in order to do that? And for what? What is the end goal? I mean, if we kill the labor market, basically we have to throw the economy into a massive recession. We're going to kill the stock market as well. So you're killing the rich, the old, and the wealthy, the boomers, and you're also hammering the young. And what do you get in return? Going back to 2% inflation? I mean, what is the 2% target? Does it really matter? I mean, what's wrong with having 3-4%? Anyway, inflation is falling already, right? So I think that this is why Powell is feeling confused. Like first 6 months of the hike, it was clear, I'm going to hike every meeting, 50, 75, whatever. And now that inflation is rolling over, the trade-off becomes more apparent. Do I really want to kill the labor market? And I hope he does not.
Well, you know what's so fascinating to me about this conversation is the tendency that people seem to have for, conflating or mistaking or for whatever reason attributing to sort of vague cultural causes, things that are just so clearly arithmetically demonstrable. I'm Sicilian, I can say this. So you hear that when people talk about, people, guys live at home until they're 40 in Italy, and it's because of mama's spaghetti. It's not. It's because of the youth unemployment rate at near 50%. I mean, we always seem to mistake collectively as a culture, whether it's on the left or on the right, this tendency to attribute these things to these cultural changes rather than these very clear mathematically demonstrable points that you make. I mean, these numbers about the changes in the price of assets relative to wages are just striking.
Yeah, no, it's easier to, I think you have two reasons for what you describe. One, it's more fun, right? Oh, you make fun of the Italian mama's boy who stays and eat the pasta. And you make fun of the millennial, spending all his money on fancy coffee instead of saving the boomers. Even though I don't think boomers, whatever. But well, so that there's a fun thing, and then there is a personal responsibility aspect, which sometimes I don't like. It's almost making poor people feel guilty for being poor, right? If you are poor, it is only on you. It's because of your avocado toast and not because of all these structural forces, which we have engineered. I mean, there was a choice to be made. I mean, I would put the late 90s, the bailout of LTCM was probably the first time we saw that. Then after 9/11, bringing the Fed funds rate to 1%, when probably that was excessive, trying to basically engineer bubbles on top of bubble. Every time a bubble pops, we engineer another bubble. So the internet bubble pops. How are we going to fix it instead of kind of letting it do its thing, which would have been a great option, right? I mean, Pets.com was not a good company, and it was good for the market to clear that out. No, what we did is we got rates really low so that we engineered the real estate bubble. And then when that popped in 2008, we went full speed with QE and we engineered an everything bubble. And same thing after COVID. And at some point, there is a cost to this. There is a cost. And the cost is that young people cannot acquire assets. Growth starts to slow. Participation starts to drop. Something else that happened in 2021. I mean, one of the mistakes the Fed did when they started buying all these mortgage-backed securities and treasuries, the price of everything shot up to the moon, and a lot of people say, hey, I don't need to work anymore. We have about 3 million extra people who retired in 2021 because of the everything rally. So you could see that solely using the wealth effect as a single tool for economic policy comes with severe side effects, which are born primarily on the young, the poor, the working, and benefit primarily the idle, the rich, and the old. And it's time for this to change. And I believe we have started this process in 2022, and it's going to play out over the next decade.
Yeah, and by the way, I'm not taking a policy position here. Obviously, these are very difficult trade-offs from a macroeconomic standpoint, balancing the dual mandate of the Fed, figuring out where the component of unstable prices causes more pain or more damage than what we were seeing in problems in the labor market. But at a certain point, you kind of have to say, like, enough with the damned avocado toast stories. I mean, look, I have friends whose parents own perfectly normal, perfectly nice houses built in the 60s and 70s that are worth $1.2, $1.3 million. And the cabinets are the same from the Carter administration. But that doesn't matter because when someone comes and buys the house, they're going to knock it down anyway. These are real structural challenges with the economy that it's not something that you can somehow thrift your way out of. Hard work and pulling yourself up by your bootstraps isn't going to do that when you're 35 years old and paying rent, because the houses that are within driving distance of where you work, for example, are just completely, they're 40x your salary.
Yeah, and I think broadly speaking, that is the biggest economic problem, I would say, for the next 10 years is going to be the transfer of assets from boomers to millennial and Gen Z. So, boomer median boomer is turning 64 this year. That's the age when start to retire, and the oldest boomers are in their 70s, and they're going to start to pass. They own a disproportionate amount of the wealth in this country. This wealth needs to pass down to millennial and Gen Zers. The problem is that millennial and Gen Zers do not have the income to purchase. So the market's not clearing. The price is that, and then the income is another number that is not sufficient. So somehow in the course of the next 10 years, we'll need to meet the two, because it will have boomers will not live forever, and at some point, millennial Gen Zers will need to buy some homes. The question is, how do we do this process? Do we do it violently, or do we do it somewhat smoothly and peacefully by reducing the real value of assets, which is what inflation does, and inflating the nominal value of wages, which is what inflation also does if it's the right kind of inflation, kind of bottom-up inflation, labor market-driven inflation. And I believe this process has started after COVID. COVID accelerated a lot of these trends, like COVID accelerated a bunch of stuff. It also accelerated that, the Great Resignation. People start to work from home. So as a result, that redistributes a little bit the real estate wealth around the country. And it's a good thing. It's a good thing that's happening.
Yeah, a couple of important points here. First of all, obviously, it's a matter of degree when all item inflation is running at 8.6% on an annualized basis. Clearly, it's destructive to the economy, and we don't want to minimize that here, because inflation does carry catastrophic risk, particularly when it becomes uncontrolled. But wherever you fall on this spectrum, wherever you fall in terms of the trade-offs for these very difficult questions, it begins by having conversations like these and asking these questions. I can see right now, for example, I'm looking at the YouTube chat, which is just blowing up around this conversation, a huge amount of engagement. And also I'm looking at the Real Vision website, where folks are also jumping in with lots of questions and lots of points. It really is a topic that clearly has touched a nerve with a lot of our viewers here, which is why we have these conversations. But I want to shift gears here a little bit. As fascinating as this sort of broader conversation is about the macroeconomic framework, based on your analysis of where we are right now, what is the implication for asset prices, for investors, for folks who are out there thinking about what this means for how they're going to make investment decisions?
So it's a bit paradoxical, but I think my view has been generally more bullish on the consensus on the economy and more bearish on asset prices. And I think broadly speaking, that was correct in 2022. We had an economy that performed quite well. Even, Q4 GDP was close to 3%. If you look at the Atlanta Fed now, it seems that GDP is also going to print pretty high. We did not have the recession that we were expecting. And I think that is because again, the labor market remains tighter, wage gains are stronger than people think, and that's rebalancing is healthy. So I think on the economy side, it's generally a positive news. I think hopefully this is a transition towards a higher growth period where we see more investment in homes, more household formation, more rapid wage gains. Now, the offset to that is, to some extent, the economy is a zero-sum game. If you give more to labor, you have to take it from somewhere, and that somewhere is going to be capital. So I think the impact is going to be quite bad on margins. Something we're seeing already, right? One stat that fascinates me is, we have nominal GDP growing at close to 10% right now, 7% inflation, 3% GDP. And still, you see S&P 500 earnings down 5%, 7% ex energy. And then you have analysts who are telling you that by the end of next year, growth is going to plummet, but EPS is going to explode. No, what's really going on is margin erosion. I think it was hidden a little bit by inflation, because initially there's inflation illusion, right? Because you don't write off your old inventory and your fixed assets are still at the old cost. It seems to boost profits, but the more you settle in this high inflation environment, you start to realize that margins are getting eaten. And I think they will keep getting eaten because the cost of everything's going up, right? Every input's going up. The cost of energy is higher than it was last year. The cost of labor is only higher, and the cost of money, as measured by interest rate, is much higher. So you'll see your margins come down. And then the other thing that will do for asset price in general is, at some point, you will need long-term interest rates to catch up with the reality that inflation is more likely to be 4 or 5% than 1 or 2. what's being priced right now. So as you get these higher rates, you write down the value of long duration assets. Unfortunately for the US stock market, it's a very high duration index. So we'll go back to kind of the trade of 2022, where your super speculative, hyper growth, big tech stocks are getting hit the most. And on the contrary, the short duration plays, the value, the energy, maybe some healthcare as well, the banks benefit from that environment of rapid high inflation and rapid growth.
Gosh, I have so many questions I want to ask about fixed income in just a second. But let me ask you this. Maybe you've got me in an optimistic mood. You mentioned this idea of the trade-offs in terms of growth between the wage and labor share of the economy versus the earnings component of the economy. Is there some possibility here where you can have this kind of Goldilocks scenario where you get growth in nominal GDP, kind of essentially pushing the Pareto optimality production possibility frontier further by growing the pie rather than making exclusively allocative decisions?
Yeah, I think that's the hope, and sometimes it's possible. I think we need to wait and see how it plays out. I mean, the productivity ultimately is what will determine whether we can get to that happy scenario where we can rebalance, but because the pie is growing, we rebalance without taking from anyone, right? Kind of like, I would say, when it was in the 50s or in the 60s, right. When you had this 2% productivity growth, we had all this innovation, the interstate highway, the GI Bill, the electrification, the spread of combustion engine aviation, all these big innovation that meant that we could have both a level of prosperity for the middle class. I mean, this is the emergence of the American middle class after the war, right. And also a strong stock market, strong profits, strong growth. That is the, and also, and it's something we haven't discussed yet, deleveraging of the economy, right? That's why the high growth of the 50s and the 60s, it took your debt to GDP ratio, which went crazy after World War II, and then it went away because the economy was growing so rapidly that the GDP was growing faster than the debt, and that shrank. That is the happy scenario. We'll see. I'm not as optimistic. If you look at trends in productivity growth, they've been very dismal. So last year, productivity fell by 2%. This was the first time productivity fell since, interestingly, 1974. So again, going back to the 70s.
And were there a similar set of causal drivers of that back during the Carter administration versus where we are today?
Yeah, I think the consensus, especially if you read the Fed papers about the topic, and I've been reading a lot about the 70s, is that the 70s is a world apart, right? And you could understand that if you were the Fed chairman, you would want to suggest that this will never happen again because it's nightmare scenario for the Fed, right? Stagflation, Phillips curve moving, so they really insist on the peculiarity of the 70s. Say, well, we had these oil shocks from OPEC, and there was the Vietnam War, then there was the food prices were going up, and then you had the big labor union that were driving pay increases, and you had a Fed chairman that didn't know what to do, and on top of that, you had a president that was bullying him. Nixon was bullying Arthur Burns, and that's why it happened. But it will never happen again. If I look at it objectively, I'm not so sure things are that different right now. I mean, energy shocks, obviously, we have them. It's not just Russia. I think that the green transition will mean that we're going to have to, at least initially, invest more for the same energy output. So kind of same story as the 70s. Food prices, you can certainly see that happen as well. We have because of the fertilizer crisis, you can think that this food inflation is going to keep going. And then, yes, we don't have unions anymore, but we have a very profound shift, I think, in labor relation. I mean, you see unionization at Amazon, you see strikes all over the country, you see the Gen Z resigning or doing the quiet quitting, right? You have kind of a similar, I think, shift in values among the young generation. Right. And I think that shift in values is driven by the fact that they have more power. You have 2 boomers retiring for every 1 Gen Zer entering the labor force. So the Gen Zer can tell the boomers, hey, no, I'm no longer your slave. Like, I don't want to work weekends. And, what are you going to do?
That's going to be a very popular message with Gen Zers. But I wanted to just point out two things, and I know we have to move on. I'm going to get yelled at for running too long, but this is such a great conversation, Vincent. First, obviously, there are distributional issues within the set of goods within the market basket for inflation, some of which is much more painful to workers than others. I mean, I can speak from personal experience. The sticker shock of going to a grocery store is miserable, and it is something that is really hurting workers. Second point, I don't think we have time to bring the chart up on the screen, but I am also looking at the federal debt, total public debt as a percentage of GDP data series on the Fed data, St. Louis Fed website right now. And you could just see it just rises hockey stick beginning with the global financial crisis circa 2007, 2008 era. And that, of course, is a challenge and a potential driver of inflation that could have some impact and could get potentially out of control. So if you could just address those 2 points really quickly so we can then.
Right. Okay, so on the inflation, I actually reconstructed, the CPI is an average, and there's a lot of stuff that goes in, and we've all become a lot more familiar with, the OER and the way they compute shelter. But what matters is it is a statistical construct that is an average, supposedly for the urban consumer. I think there's a generational component to the CPI as well, because you have a very different consumption basket if you are young or if you are old. If you are young, you're going to pay a third of your salary on rent. Typically, you don't own your rent. You're going to have to pay a lot of money for college, and you're going to have to pay maybe another 10% of your income on health insurance. And these three sub-indices of CPI, shelter, higher education, healthcare, and then childcare if you have young kids, have already been rising at 5% a year for 20 years. So I would argue that the millennial and the Gen Zs have been living in a 5% CPI world for already 40 years. Now, the reason we had 2% CPI is because on the other side on the rest of the index, on the good side, we had all the cheap stuff from China, which the boomers buy, right? So the boomers, they don't have to pay for their home, they own it. They don't have to pay for higher education, they're done with college, and they don't have to pay for healthcare because they got Medicare. So we were already, I would have wished that the BLS would have reported two sets of numbers, and that would have been very cruel for the millennials. Say, okay, for boomers, inflation is negative again this month. Now, unfortunately, for anyone who is under the age of 25, inflation is 6%. That is what has been going on for 40 years. So that's one of the reasons why I am not that horrified at whatever the CPI is right now, 6%, 6% inflation, because effectively that's what millennials and Gen Zers have been living under. So that's the first thought. Second thought was about debt to GDP, and I think that's an important one. So let me address it. Basically, over the long term, if you want to keep a constant ratio of government debt to GDP, which you kind of need to, right? Otherwise, you just keep building and building. That means that your deficit to GDP must equal the rate of nominal growth of the economy. So if you have, like we had, I would argue in the past decade, the government deficit was about 3% of GDP. You can get there by having 2% inflation, 1% growth. So that's fine. That's an equilibrium. It doesn't really rise. Now, if, and I believe it is the case, we enter in an era of structurally higher deficit because you have to pay for the retirement of the boomers and you have to pay for the healthcare expense of the boomers. And on top of that, you have to build the military out of scratch, which is the case of Europe. Suddenly, Europe is waking up in horror. Germany, oh my God, we have to spend 3% of our GDP in defense, which we haven't done for 40 years. And at the same time, we have to pay for soaring healthcare expenses. That means that structurally, your deficit to GDP is going to be maybe 8%. Now, how do you avoid a debt crisis when you have deficit to GDP of 8%? The answer is very simple. You need the numerator to grow by 8% as well. How do you get there? I would argue that 6% inflation, 2% real growth is a great way to do that. You can deleverage the economy by having high nominal growth. And we don't have a choice unless we are willing to cut into entitlement or defense spending, which I don't see anyone wanting to do. I mean, no one's going to touch Social Security, and Social Security is inflation indexed anyway, so you can't really go at it. Or cutting military spending, you're going to see these bigger and bigger deficits. So how do you want to solve it? I mean, do you want to default on the debt? It's much better to let go of inflation for a couple of years.
Just when I was feeling optimistic, Vincent, you go and mention these real world trade offs. And these are obviously very difficult. People have experienced just tremendous pain with inflation, particularly workers, particularly folks at the lower end of the economic income distribution. So those are real challenges. But to your point, obviously what we're talking about here today, these real generational challenges around asset prices, particularly around housing, which has risen sort of pari passu with the rate of asset inflation in publicly traded equity markets. I wanted to get in just one question here. Ralph Humphrey actually asks a question that I was asking earlier, but maybe if you could boil it down in a very concise way. Ralph wants to know, what is your investment thesis? What is your investment view based on this thesis?
I would say the overwhelming one trade would be short duration.
What does that mean for people who may not be familiar with the terminology?
It means that you want to invest in assets with a high tangible value and where you get your investment back fairly quickly, as opposed to assets like some pie in the sky tech stock where maybe in 10 years they will just they will have losses for the first 10 years, but after that, oh my God, it's going to be so wonderful. Right, the opposite of the vision fund, if you will.
That sounds like long XLE, short XLK.
To some extent, yes, but I mean, yeah, I would put the banks in that short duration basket, for example. So it's not just energy. I think healthcare is also an area that will benefit from a lot of these changes that I highlight. But in general, yes, there would be a value over growth element. There will be a pro-inflation bias. So you want to have things that benefit from inflation, things like miners, maybe some emerging markets, maybe some commodities, and also cash. Especially after the rate hikes that we've seen. Hey, close to 5% on a 2-year note. I mean, this is, by the way, I'm an inflationista, and I do not question the fact that inflation is going to fall. Arithmetically, it's going to fall. So we do have positive real rates in the US for the first time in a very long time. You have tips. I mean, even a 2-year tip is going to give you 2% in real inflation adjusted income. And that really raises the bar for everything else. I mean, this is an option that did not exist 5 years ago. And I think the rest of the world needs to reprice to adjust for that. And as this happens, you'll be very happy that you have some cash. I mean, you don't necessarily have to keep it in cash, right? I mean, you can buy like short-term T-bills or things like that so that you get compensated for it. But as we see more dislocation in the rest of the market, as this repricing takes place, you want to remain liquid.
Yeah, so I guess we could add to that short XLF, long XLV. I'm looking at the comments right now, which are just flying by. Bonito makes an interesting point. He writes, the answer is metals, gold, silver, and lead. LOL. This is in some ways it's sort of an interesting story. Obviously, we have seen a lot of action in gold lately. So much more to talk about. I wish we had more time. Vincent, you've got to come back and do this again. This was a fantastic conversation.
It was awesome. I always enjoy going there, and let's speak again soon. Thank you.
Thanks again. Thank you again for watching the Real Vision Daily Briefing. Tomorrow we'll be back with Jared Dillian. See you then. Have a great night, everybody.